Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Welcome to the debate. It is Friday, January 30th, 2026. If you have been watching the ticker tape this week, you've almost certainly seen a specific sequence of letters flashing red, then green, then halting entirely. We're talking about Phoenix Asia Holdings Limited, ticker PHOE.
Right. The ticker that has likely caused more heartburn in the last 6 months than, the entire rest of the Hong Kong industrial sector combined.
It certainly hasn't been boring. We're looking at a company that priced its IPO at $4 back in April 2025, surged over 500% to touch nearly $25 in October, and as we sit here today is trading, violently in the $13 to $14 range.
And let's not just gloss over the halts. We've seen these code T5 volatility pauses freezing the stock repeatedly. October 11th, December 4th, January 6th. That isn't normal price discovery. That is a market having a seizure.
Or a market struggling to price a scarce asset. And that really is the central question we are debating today. Is Phoenix Asia Holdings a fundamentally sound, high-efficiency hidden gem in the Asian infrastructure space that is, currently coiled for a massive liquidity squeeze? Or is it a microcap valuation hallucination completely disconnected from its balance sheet?
I am firmly in the hallucination camp. I think we are watching a game of musical chairs where the music is about to stop. And when you strip away the momentum, the float dynamics, all of it, you are left with a company trading at a valuation that just defies every law of financial gravity.
And I am here to argue that gravity works a little differently when you have the structural setup that PHOE has. I believe the market is mispricing the moat of their specialized licensing and, frankly, the explosive potential of their share structure. The fundamentals are better than the headline price suggests, and the technicals are absolutely screaming short squeeze.
Well, let's start with the business itself. You call it a hidden gem. I look at it and I see a very, very small construction firm. Why should anyone care about a company that, pours concrete and stabilizes slopes?
Because they're the ones who make sure the skyscrapers don't slide into the ocean. Look, the core operating entity here is Winfield Engineering. This isn't some shell company whipped up for a listing. Winfield has been a registered specialist contractor in Hong Kong since 1990. They have survived the Asian financial crisis, SARS, the 2008 crash, and the recent property downturn.
Okay, longevity is nice, but we are here to talk about value.
Exactly. And the value driver here is efficiency. In late 2025, Phoenix reported a return on equity, an ROE, ranging between 33 and 42.6%.
Which is, I'll admit it, a very shiny number.
It's an incredible number. Most construction firms are lucky to grind out 15%. Phoenix is nearly tripling the industry average. And they did it with virtually no net debt. This is the hidden part of the gem. The market looks at their size and dismisses them. I look at their balance sheet, and I see a capital-efficient machine that doesn't waste money on bloat. They don't have yards full of rusting yellow iron. They have licenses and high-margin contracts.
But efficiency can only justify so much of a premium. Let's talk about the valuation disconnect, because this is where your argument really falls apart for me. We need to put the numbers in context. As of this morning, Phoenix Asia has a market capitalization of roughly $291 million.
Correct.
Okay. Now let's look at the revenue that supports that $291 million valuation. For the fiscal year 2024, their revenue was approximately $7.37 million.
They are a niche player, not a volume player.
Niche? That's microscopic. You are paying nearly $300 million for a business that generates $7 million in sales. That is a price-to-sales ratio of what, roughly 40 times? But the earnings multiple is where it gets truly frightening. The P ratio has exceeded 250. At the peak of the mania in October, it was over 2,000.
You are focusing on trailing metrics for what is really a growth story.
I am focusing on sanity. You pay 250 times earnings for a software company that can scale to 1 billion users overnight. You do not pay 250 times earnings for a company that has between 21 and 29 employees.
Quality over quantity.
There is a limit to that logic. I mean, think about it. A $290 million market cap divided by roughly 29 employees. The market is valuing each employee at $10 million. Unless these guys are literally pouring liquid gold instead of cement, that math is just broken. This isn't about business quality, it's about float scarcity. There are only 5.5 million shares available to the public. The price is high because the supply is artificially low, not because the business is booming.
But scarcity is a form of value in the modern market structure. However, I want to challenge your assertion that they are wildly overpriced compared to the industry. You think they are an outlier?
They aren't just an outlier, they are on a different planet. Let's do a direct peer comparison. Let's look at Concrete Pumping Holdings, ticker BBP.
Okay, a standard, capital-heavy industry player? Sure.
It is the perfect control group. BBCP has a market cap almost identical to Phoenix, hovering right around that $293 to $300 million mark. So for the same price, what do you get?
You get a lot more trucks, I'll give you that.
You get a lot more business. BBCP generates roughly $393 million in revenue. Phoenix generates $7 million. That is a 53-fold difference. 53 times the revenue for the same stock price. BBCP has over 1,500 employees. They operate across the US and the UK. Or, I mean, look at Matrix Service, MTRX, or Orion Group, ORN. These companies have $700 million in revenue and trade at comparable market caps to Phoenix.
And that is exactly why I wouldn't touch them.
Explain that. You wouldn't touch the company with $700 million in revenue, but you love the one with $7 million?
Absolutely. Because look at the liability side of the ledger. Matrix and Orion carry significant debt loads to maintain those 1,500 employees and massive fleets. They are heavy, cyclical, capital-intensive dinosaurs. If the economy slows down, their overhead eats them alive. Phoenix is agile. Winfield works under the main contractors. They take the specialized margin for, say, marine grouting, without the balance sheet risk. You are paying a premium for safety and agility.
Safety? You call paying 40 times sales safety?
I call a debt-free balance sheet safety. The barrier to entry isn't buying a truck. Anyone can buy a truck. The barrier is the license. You cannot perform specialized marine grouting or diaphragm wall construction in Hong Kong without the specific registration. That license is the asset. That is what protects the 40% ROE.
Margins don't pay the rent if the revenue base is that small. But let's pivot, because I know you believe the real story here isn't the PE ratio but the market mechanics. You think the broken valuation is actually a setup for a trade.
It is the setup for the trade of the year. We have to talk about the short interest in the dark pools because the data there is, it's just flashing red.
It definitely looks unusual.
It's a powder keg. Let's look at the days to cover. This is the critical metric. It measures how many days it would take for short sellers to buy back their positions based on the average daily volume.
Right, and anything over 10 days is usually considered a crowded short.
Phoenix is sitting at 14.34 days. Because the daily volume is so thin, I mean, sometimes we see days with only 700 to 2,000 shares traded, the shorts are trapped. If they try to exit, there is simply no liquidity to absorb their buy orders. They would have to bid the price up vertically just to find sellers.
That assumes they need to exit.
The borrow data says they might not have a choice. In mid-January 2026, prime brokerages showed about 1,000 shares available to lend. By January 15th, that number dropped to 100 shares. The cupboard is bare. You cannot borrow this stock. The easy short trade is over.
And what about the off-exchange activity?
That is the smoking gun. On January 9th, we saw the off-exchange short volume ratio hit 62.5%.
Right. And for our listeners, that just means the short selling is happening in what are called dark pools, so not on the public exchange.
Exactly. Why would you route 62% of your short volume to a dark pool? Because you are terrified of moving the price on the lit exchange. These sophisticated players are trying to suppress the price or trap liquidity in the shadows because they know the order book is paper thin. When you combine 62% dark pool shorting, 0 shares to borrow, and a 14-day cover ratio, you have the recipe for a violent squeeze. All we need is one spark.
See, I look at that same liquidity data, and I don't see a coiled spring. I see a desert. You are interpreting the lack of volume as scarcity. I interpret it as abandonment.
Abandonment by whom?
By the smart money, by the institutions. If this was such a high-quality, high ROE hidden gem, where are the big boys? Look at the 13F filings from Q4 2025.
Microcaps often have low institutional ownership.
This isn't low, it's non-existent. Citadel Advisors and Tower Research Capital, firms that are literally built to trade volatility and arbitrage, they closed their positions entirely in November 2025. They took one look at this squeeze setup and walked away.
Where they took profits after the 500% run.
UBS reduced its position by 97%. They are holding 161 shares. That is not an investment. That is dust left in the account. When the market makers and the algos leave, liquidity dries up. Those T5 volatility halts we mentioned earlier, those happen because the order book is broken. There are gaps in the bid-ask spread, wide enough to drive a truck through. If you are a retail investor buying this squeeze thesis and the price starts to drop, who are you going to sell to? Citadel isn't there. Tower isn't there. You are trapped.
I think the institutional exit is temporary. They hate volatility until they can control it. But while the institutions are out, the insiders are heavily in. Kelvin Young, the CEO, he controls nearly 75% of the company.
Which brings us to the concentration risk. Because if the stock structure is concentrated, the revenue structure is even worse. This is the fundamental anchor that drags down your whole efficiency argument.
You're talking about the client list.
I am. For the fiscal year ending March 2025, Phoenix Asia's top 5 customers accounted for 93.7% of their revenue.
That's high, I admit it.
It's terrifying, but it gets worse. Their largest single customer accounted for 50.4% of revenue. Half the business depends on one relationship.
But that is the nature of the industry in Hong Kong. You are a specialist subcontractor. You get hired by a main contractor for a massive, multi-year project. Of course your revenue is concentrated during that project.
But what happens when the project ends? I mean, look at the backlog. It dropped from roughly $4 million in 2024 to about $1 million in 2025. They are burning backlog faster than they are replacing it. If that one main customer decides to use a different piling contractor for the next job, Phoenix loses 50% of its revenue overnight.
You are missing the forest for the trees on the client risk. Who is the ultimate client? It's almost always the Hong Kong government. We are talking about public infrastructure, the Trunk Road T2 project, the riding school redevelopment. These are government checks. The credit risk is zero.
The credit risk is zero, but the contract renewal risk is 100%.
But they are delivering. The marine grouting work on the Trunk Road is scheduled for completion in late 2025. That is a massive revenue recognition event. That backlog number you are citing is backward-looking. It doesn't account for the cash that is about to hit the books when they sign off on the completion.
So you are betting on a singular event.
I am betting on their technical competence, and the management signals agree with me. In late 2025, they expanded the board to 7 members. They added Yafei Xie and Yaqiao Xie. You don't bring in new independent directors with capital markets experience if you are winding down operations. You do that if you are preparing for something bigger. Maybe M&A, maybe a new round of bidding. They are gearing up, not slowing down.
Expanding a board is a lot easier than replacing 90% of your revenue stream. But I want to bring up one more factor. It's a bit unusual, but I think it explains a lot of the erratic price action we've seen. It's the polymarket correlation.
Ah, the mistaken identity theory?
It's more than a theory, it's a pattern. The ticker PHOE is incredibly similar to the Phoenix Holdings Ltd., which is a major Israeli insurance and financial giant.
They are completely different companies. One is in Tel Aviv, one is in Hong Kong.
Humans know that. I'm not sure the algorithms do. The Israeli Phoenix is a top holding in the VanEck Israel ETF, ticker ISRA. We have seen this weird correlation. When Polymarket shows high betting volume on Middle East volatility or Israeli geopolitical events, PHOE in Hong Kong sees these sudden spikes in volume.
So you think the algos are scraping the wrong ticker?
I think glitch arbitrage is a real thing. Retail traders or primitive sentiment bots see news about Phoenix in the financial press regarding Israel, and they mash the buy button on PHOE because it's a cheap stock with high momentum. You aren't investing in Hong Kong infrastructure. You are trading on a database error.
I acknowledge the noise exists. Ticker confusion happens. But I would frame the correlation differently. I don't think it's just a mistake. Look at October 2025 when PHOE hit its peak of $25.
Right.
That coincided with a massive surge in polymarket volume regarding China market stability and the famous commodity trading halts. Remember when silver futures premiums hit 36% in Shanghai?
I remember. The arbitrage windows were shut.
Is a Hong Kong asset pegged to government infrastructure spending with a clean balance sheet. The volatility attracts attention, yes, but it also signals that PHOE is being used as a macro vehicle. It's a way to express a view on Asian stability when other doors are closed.
That is a fascinating theory, but it reinforces my point. If the stock is moving because of silver futures in Shanghai or mistaken identity with an Israeli insurer, then the stock price has absolutely nothing to do with whether Winfield Engineering pours good concrete. It makes the stock a gambling chip, not an investment.
But that gambling chip status is what creates the liquidity squeeze. You have algos buying for the wrong reason, shorts trapped because of the low float, and a solid business underneath is about to report a massive project completion. It is the perfect storm.
Or the perfect trap.
So, where do we land?
I look at the board and I see danger. I see a valuation of 250 times earnings for a company with $7 million in revenue. I see a declining backlog. I see the smartest institutional investors, Citadel, Tower, UBS, all heading for the exits. And I see a stock price propped up by confusion and thin liquidity. When the momentum breaks, there is no fundamental floor until you get down to maybe $1 or $2.
And I look at the same ORD and see opportunity. I see a debt-free company with elite ROE. I see a share structure that is mathematically impossible to short right now because the borrow is gone, and the days to cover is at 2 weeks. I see a technical setup where a single piece of positive news, like a new contract in the February earnings, could trigger a vertical squeeze right back to $25.
The moment of truth is coming up fast.
February 6, 2026. Expected earnings release.
That is the date to circle. We will see if the revenue cliff is real or if the backlog has been replenished.
Until then, watch the level 2 data. Watch for those T5 halts.
And maybe double check that you aren't buying an Israeli insurance company by mistake.
A fair warning. But for those who understand the risks, PHOE remains one of the most fascinating market mechanic plays on the board right now.
We will be watching. And as always, nothing we say here is financial advice. Do your own due diligence. Read the 20F.
And decide for yourself. Thank you for joining us on The Debate. We will see you next time.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.